By the way, Secretary Lew made those comments on tax inversions today at the so-called Delivering Alpha conference in New York. That's hosted by CNBC and Institutional Investor. Market-moving news typically comes out of this conference each year, and this year proved to be no different. Tyler Mathisen was there. He has a look at who attended and what was said.
Bill, thanks very much. It may have been a bad hair day here in humid New York City, but it was a great day if your interest is in investing ideas. I've spent the day at Delivering Alpha, an investment conference that is a joint venture of CNBC, which of course produces Nightly Business Report, and Institutional Investor magazine. We heard from some of the very best and brightest in the world of money management and hedge funds, beginning the day with Ken Griffin, the chief of Citadel, who basically endorsed 21st Century Fox's offer for Time Warner. He said it's going to be very hard for Time Warner to say no to this deal.
Time Warner, great assets. HBO, Warner Studios, content is king. Both those assets have great content. The deal makes a lot of sense for Fox, makes a lot of sense for Time Warner shareholders.
We then heard later in the day from Stan Druckenmiller, who really took the Federal Reserve to task.
It is particularly puzzling today that the Fed is using wage growth as a key determinant of their current stance of policy. Wages lag unemployment, which itself is in the lagging indicators. Shouldn't the Fed be focusing on leading indicators? I really hope I am wrong in my assessment. I really do. In that case, I can just adjust my portfolio either way. The problem is the Fed is making a bet from which their adjustment could be way too late and have significant adverse consequences. And frankly, I don't know what it is in their forecasting record that gives them the confidence to make such a bet.
Later, Nelson Peltz, who said a proxy battle for PepsiCo is a possibility.
The stock was supposed to, according to them, earned $5 in 2012. They missed a little bit and they earned $4.10. Last year they were giving high fives because they got to about $4.34 in 2013. So the stock is not moving because of earnings when the company should have been earning $5 2 years ago. The stock is moving because people, shareholders, see the wisdom of what we're saying.
John Paulson, the author of a couple of the greatest trades of all time.
From an individual perspective, the best single investment you can make is to buy a primary residence that you're the owner-occupier of. Today, financing costs are extraordinarily low, so you can get a 30-year mortgage somewhere around 4.5%. And if you put down, let's say, 10%, and the house is up 5%, which is the latest data, then you'd be up 50% on your investment.
And more.
Cash is 0.5%, bonds 2.5%, heading to a loss on a total return basis. High yield isn't high yield anymore. And then you look at common stocks, slightly rich against history, 16 times earnings, average 15 times earnings, but 25% of the S&P today yields more than bonds. That's a highly unusual condition. So while I think the market's fairly valued, I don't think it's overvalued, and the conditions that normally lead to a peak don't seem to be present.
What a board should do is not tell the CEO what to do. They should leave him alone, really leave him alone. But what they should say, if you're not producing, and they could have a lot of ways to gauge that, which we do, a lot of parameters, and if you're not coming up with, and you're not doing as well as your peer group, get off the golf course and get to work.
A very interesting symposium, one of the preeminent ones in the world of investing. Now back to you.